Welcome to the Reporting Revolution. This video analyzes the SEC proposal for semi-annual disclosures and its strategic implications for both global and Indian financial markets. We will explore how this proposed shift impacts corporate reporting worldwide. The SEC, established in 1934, is the U.S. federal regulatory agency focused on restoring and maintaining investor confidence. Its three-part mission is to protect investors, maintain fair markets, and facilitate capital formation to drive the broader economy. The SEC proposed Form 10-S in May 2026, allowing public companies to switch from mandatory quarterly or 10-Q to semi-annual or 10-S reporting. This regulatory shift is part of the Atkins agenda, aiming to lower listing barriers and attract more private firms to the public markets. This push for long-termism addresses issues like managerial myopia, where quarterly pressures hurt R&D. It aligns the U.S. with the semi-annual baselines of the U.K. and EU, reduces costs, and provides market flexibility for companies to choose the best reporting cadence. The shift benefits sectors like biotech and R&D, allowing a focus on clinical milestones. Deep tech firms, with longer product cycles, can prioritize engineering achievements over quarterly earnings. Small-cap SMEs on the Russell 2000 also see a significant reduction in compliance overhead. Semi-annual reporting significantly reduces compliance burdens. The estimated savings come from cutting repetitive boilerplate disclosures and reducing the preparation needed for frequent earnings calls. This directly translates to cost reduction for companies. Now let's explore the Indian context and why SEBI is likely to maintain the current reporting cadence. The primary concerns in India differ significantly from the U.S. focus on capital formation and long-termism. India faces a persistent insider trading menace, often involving promoters and brokers. Moving to less frequent semi-annual reporting would increase informational asymmetry, a risk exacerbated by the absence of a short-swing regulation in India. In India, the status quo benefits retail investors, who rely on quarterly checks due to weak insider trading penalties. Audit firms like the Big Four also maintain revenue from extensive quarterly reviews. Market analysts use this high-cadence data flow to combat market opacity. Looking at the global landscape, the U.S. is proposing a shift from quarterly to semi-annual to promote long-term strategy. The EU and UK are already semi-annual, driven by transparency and market competitiveness. India, however, remains quarterly due to insider trading risk. The graph shows how information asymmetry risk, which can be mitigated by quarterly checks, could increase without them. The absence of frequent disclosures creates a retail information gap, potentially allowing information to leak or be exploited over longer periods. The final takeaway is that while the U.S. prioritizes making IPOs great again, India's regulatory stance is focused on retail protection and combating market opacity. Thank you for viewing this video.